All right, well, welcome. Today's topic, actually, I'm going to address the keys to success in retirement, but I want to be mindful of what we have going on in the markets right now and what we see as potentially the beginning of the sell-off going into a recession. And I'm going to talk to you about why we think that's happening, what has come out of the pandemic and all the stimulus that was put into the system and the unwinding of that now. And through a lot of charts and graphs, I'm going to talk about, where we think we are, where we think we're going, and what potential downside to this market is, and some places to hide, which would be part of your keys to success in retirement. So without further ado, I'll go ahead and get started here. The one thing I will also mention for those of you that have not looked at the website yet, next month, traditionally in October, I go over the 403B and 457 retirement plans at UCSD. So if you're interested in your own retirement plans and different strategies within that, please join us next month. So let's talk about the stock market, and I think this is appropriate today with the market in a big sell-off. I think the last time I checked, the Dow was down about 400, and the Nasdaq was down about 1.5%. But let's take a step back and look at the big picture, okay? This is going all the way back to 1996. As you can see in the bottom left corner, we have the bear market that lasted from basically the top of the dot-com bubble through 2010, 11. And then we got this nice run up from 2011 to 2020. We had the pandemic sell-off, and then we had this massive rally up to the end of 2021. And everyone knows that 2022 is a very difficult year. And I don't come bearing good news because I think it's going to take a couple of years for us to probably, a couple of years is probably unfair, another maybe 10 to 12 months for us to unwind all the stimulus and get profitability back to companies. And I'll go through why here in a second. From a valuation standpoint, and this chart's a little bit old. It's from the end of the second quarter of this year, but you can see up here in the top right corner, or excuse me, at the top or the very right side of the chart here, where the green dot is actually now on that one standard deviation line. If we look at the 25-year average, going back to 1998, PE ratio is simply what people are willing to pay for earnings of a company. It's a price earnings ratio. What am I willing to pay for a company's earnings, or to be an owner in a company and pay for some of the earnings? Well, historically, last 25 years, that's averaged just under 17 times their forward earnings. When we get to this first standard deviation above the 25-year average, that's usually a time when we see either a sell-off in the equity market or a market that stays flat and doesn't go anywhere for a while. And realistically, all the returns so far in 2023 have come in the first 6 months of the year. We're actually down since June of this year, and we don't expect it much upside for the rest of the year anyhow, either way, as the S&P is up, still double digits year to date. And I'm going to go through why we don't think the S&P is really telling the full story as well. But like I said, we're up there in that first standard deviation. So a really good time to maybe take some risk off the table. If we look over here on the left chart, I'm not going to really discuss the right chart. It's a little too technical, but the left chart, keys to retirement, again, value versus growth. I want you to think of growth as like tech, communication services, all these companies that don't pay a dividend, and then value as more like banks, industrials, materials, companies that pay a nice large dividend, strong cash flows, and it's not dependent on the growth of the company to bring a return to your stock. Right now, we're at one of the highest levels of overvalue in the growth sector, meaning that value's going to probably outpace growth significantly over the next 12 to 24 months. One of the most interesting dynamics, I think, of 2023 is that we're really repeating 2021. And I'll have you look or focus on the top right chart here. It's the only one really, I think, that tells the real story. The weight of the top 10 stocks in the S&P 500 as the percentage of market capitalization S&P 500. The top 10 stocks are accounting for 31.7%, or roughly a third of the S&P 500 value. That means there's 490 other stocks that compose the bottom two-thirds of the S&P 500. What we call that in our industry is very narrow breadth, meaning very few companies are really driving the return of the S&P 500. And we know which companies those have been. And if you have your UCSD funds, you've probably seen some really good gains so far this year because they're really heavily weighted in tech stocks. Apple, Meta, Google, Amazon, all those companies have done, NVIDIA in particular, very, very well this year as they recovered from a disastrous 2022. That being said, That's where almost all of the return in the S&P 500 has come from this year, and that's not good or healthy for the entire market. All right, if we also take a look here, so not focusing on the largest companies, and the top right here, we're looking at the Russell 2000, which is a index that tracks the small cap companies, right? So small, when I say small cap, usually company that's 1 billion in valuation and under. And if you look at that, this is the percentage of unprofitable companies, meaning these companies are not even making money, which means that they need to go to the debt markets, or they need to go to, well, I would say private equity, but they're public companies. They need to go to the debt markets to finance their operations. And we see almost 50%, 45.5% of companies in the Russell 2000 don't even make money. Again, not a healthy market. If we take a step back, though, and we look and we go, okay, maybe we're going into this correction, maybe we're going into a potential recession, and maybe we're going to have a really good opportunity to put some cash or some money that we have in bonds to work in the stock market. Let's look at historically. If you look up in the top left here, despite the average intra-year drops of 14.3%, annual returns were positive in 32 of 43 years. You got to remember that the stock market, as when I say stock market, I'm speaking of the S&P 500, but the S&P 500 annually averages a 14.3% decline. This year, we've only had an 8% decline so far intra-year. Am I expecting a 14.3 or somewhere in that range? Yes, actually I am for the rest of the fall here. And now bring us back in line with a 6-7% rate of return for the S&P 500 for the year. And that's about what we're expecting for end of year returns. Again, 75% of the time, the market ended up for the year despite these intra-year declines. I'll point you to the chart here on the right, bull and bear markets, right? Bull markets tend to average on average 51 months, so roughly 4.5 years in duration and 162% return. Bear markets average 20 months, roughly just under 2 years, and a negative 41% return. Now, really, that's not a return. I guess that's a loss. If you take out the Great Depression, that's more like 30 to 32% is the average bear market. And we technically started a bear market in January of 2022, and we're not done with it yet. As of the end of the first quarter, we were only 9 months in. If you add the 3 months roughly that we have had since then, we're at 12 months into this bear market. And if the average duration of a bear market is 20 months, you can see why we think there's still going to be some downside through the end of the year in the stock market. So let's talk about what drives the stock market, right? So at the end of the day, as they say in the industry, short-term prices in the stock market are driven by sentiment or the way people feel. Long-term stock prices are driven by valuations, right? And so the U.S. economy is going to be the driver of the valuation. And what composes the U.S. economy? Well, a trend growth line here on the left, 2% year over year. Obviously, you can see the pandemic shut everything down. Growth was terrible. But if you look at the right, what composes the GDP here in the United States, gross domestic product? And you look down at the bottom, you see 68.3% is consumption. That's you and me and Vanya and everyone on here going out and consuming, going to the movie theater, taking a trip, going out to dinner. All these things are personal consumption, and that's the majority, almost 3/4 of the U.S. economy. So why do we think that we're looking at a potential recession? It's all on these charts right here. If you look, and you got to kind of look close here, if you look over the very left side here, the personal savings rate as a percentage of disposable personal income, how much are we as Americans saving as a percentage of our income? So if I make $100,000 a year, am I saving 10%? Right now, our savings rate is at about 4% of our income, right? That's anemic, and that's well below the historical average of 8.9 or roughly 9%. It's basically half, right? Well, why is that happening? Well, think again about the dynamic of the pandemic and the entire country being shut down, all the restaurants, and of course here in California it was a little longer than most other places, but you could see the savings rate went up to 18, 20%. And what happened is households suddenly had all this extra money, this extra savings. If you look over here at household excess savings, which is the top right, you could see the personal savings rate just skyrocketed during the pandemic because you couldn't go out and spend money anywhere, right? So if you can't spend money anywhere, what do? You put it in the bank. We'll put on top of that, you had loan forgiveness, you had PPP for small business owners, you had employee retention credits for small and large business owners, and you had extended unemployment benefits. And so people were taking that money, and you could see this big light blue bubble here on the right side is the excess savings over the pre-pandemic trend. And you could see it amounted to $2.1 trillion in excess savings that the American consumer had. That has been slowly unwound and is now at zero and rapidly going below the pre-pandemic trend because of the chart over here on the left, where people aren't saving nearly as much as they used to. In addition, if you look at the bottom right corner, you can see the revolving consumer credit outstanding is rapidly rising now. So everybody paid off their credit cards, and now those credit cards are the credit card balances are increasing for the consumer. And again, if we look back at what composes GDP here, and again, just for definition purposes, definition of a recession is 2 negative quarters of GDP. It's a little bit more complicated than that, but that's traditionally what we've thought about as a recession. Okay, well, if the GDP of the U.S. is 70% the consumer, we need the consumer to have a recession. You need the consumer to really fall off the cliff, meaning they're not going out and buying as much. They're not spending as much maybe at Christmas. They're not going out to dinner as much. And most importantly, they're not traveling much. Just a little anecdotal evidence. If you go to the airport, I flew in yesterday into San Diego International from Reno. And at the airport, I saw the longest security line I've ever seen in my life for Terminal 1 going into Southwest. It was all the way down the hallway. It had to be, I don't know, a couple hundred yards long. But I also yesterday received about 30 spam emails advertising sales on tickets in the future. So what we're seeing at the airport are flights that people and the trips that people booked, 6, 9, 12 months ago, when that excess savings was being unwound. And I'm getting all of these sales and offers on airplane tickets because the demand in the future has fallen off the cliff. And I think that's an anecdotal sign, but I think what it tells us is that demand is falling much more rapid than is perceived right now. Because again, we're seeing right now in the consumer, we're seeing the spending that happened, 3 to 6 months ago on trips and what have you. So what about inflation, right? So and let me take a step back here. One of the reasons this excess savings rate is going down is also people are, having to either refi or get a mortgage now at rates that are 3 times what they were 2 years ago. And that's one of the things the Fed is trying to do by tightening interest rates, is to stamp out inflation. And it's happening, right? So inflation's coming down. It's about half of what it was at its peak at 9%, but it's not to the Fed's target rate, which is 2% per year. And they have said that they will do anything, including sending the economy into a recession, to bring inflation back into line with their mandate. If we go and look at these dark areas that are shaded areas, recession, almost every single one of these recessions coincides with a big peak in inflation. And you can see that big peak in inflation. And it's again why we think a recession at this point, I could say, is imminent. Fourth quarter this year, maybe into first quarter next year. Here's the projected Fed interest rates. They would not be lowering rates in the future if they didn't think that there was going to be a significant strain on the economy. One of the things I will share with you is I get a lot of questions about, I'd like my kids to help my kids out or my grandkids to help buy them a home. I would say, if we look back to the Great Recession, particularly here in Southern California housing prices obviously very difficult to get into the market. The Great Recession, the stock market bottom was March 9th of 2009. We came out of recession in first quarter 2010, but housing prices here in San Diego did not bottom until mid 2010 to early 2011. So housing lags because the consumer that's the last thing they're going to give up is their home. So if you do have someone in your family that's looking to buy a home, interest rates are terrible right now. Housing prices are too high. They can't carry the mortgage. I would encourage them to just wait and be patient. You're going to see better prices. And most importantly, you're going to see lower interest rates in the future so that your cost to carry the home is much lower, unless, of course, you're paying with cash. So that's my future prediction on housing as well. Nominal and real U.S. 10-year Treasury yields. What does this just mean? It means what's the difference between what a 10-year Treasury is actually paying and what it is really giving you in return because of inflation, right? If you have a 5% return, but you have 9% inflation, then you have a minus 4% real return. Well, as of June 30th, 2023, the nominal yield on the 10-year, meaning what it was actually paying, was just under 4%, We're now at 4.5, but real yields are still negative, and that's because inflation is outpacing the 10-year. When that dynamic finally switches and there's a return on a 10-year, that will be a good signal that we'll be coming out of the recession. And I'm going to go ahead and skip that. That's just the yield curve and the inversion. I think we've discussed that enough in the last couple IIGs. Let's talk about the bond market. I think we can summarize the bond market, especially last year, with one slide. And that is, despite the average intra-year drops of 3.3%, annual returns in bonds were positive 42 out of the last 47 years. And to show you how anomalous last year was, just take a look at this chart. Minus 13%, the biggest drop in bonds since 1976, including the high inflation years of Jimmy Carter and the early presidency of Ronald Reagan. Bond returns were still positive. Last year, because of how fast the Fed raised interest rates, bond returns were historically negative. So historical that I think there was only one time in the mid-1800s that bond returns were worse. So a couple of other things here. So this is, how to prepare in retirement, but I'm also giving you themes here that we think moving forward, especially for those of you that do things for yourself, themes that we think you should be looking at in your retirement portfolios moving forward. And one of the big ones is the international theme. This chart is just simply the US dollar total return and cumulative outperformance. And you can see here, when it's in the gray, that means the US outperforms the rest of the world. And then when it's in the purple, EFA, which is the Europe, Asia, Far East, outperforms the US. And we've had this 14.2-year, 277% outperformance by the US over the last 14.2 years. We think that that's probably come to an end, and it's probably going to be a good time. I'm not saying right now, but in the near future, next 3, 6, 9 months is going to be a really good opportunity to diversify your portfolio out of the United States, meaning buying maybe some European or Asian or all world mutual funds and or ETFs, however you choose to invest. By the way, I'm not in the chat when I'm going through the presentation. So if you have questions, please raise your hand or let me know if you see a question out there, Vanya, because I can only see a certain amount of you guys, so you're on the right side. Or just unmute yourself and feel free to just jump in. I'm going to skip this slide. So, what do I do to protect my retirement? And I think this slide right here summarizes probably the single most important thing you need to do in retirement, and that's diversify, right? Yes, it was a terrible year last year for bonds. It was a terrible year last year for stocks, right? But if you own commodities and alternatives, then you had a positive return, and it was a ballast to how bad the year was in stocks and bonds. This slide just on the y-axis here, we have annualized returns starting at 6% at the bottom, 10% at the top. And then on the bottom, we have what's called annualized volatility, right? Or standard deviation. And you can see it starts at 6% and 13 to the right on the x-axis. The higher the percentage, the more risky the portfolio. And then again, on the left side or on the y-axis here, the higher towards the top, then the better return. In every single situation, if you take a 60% bond portfolio and 40% equity portfolio, you reduce your stock exposure by 10% and your bond exposure by 20%, and you add in alternatives, it becomes a less risky portfolio and a higher rate of return. If you look over here, we're at 60% stock and 40% bond. If you take 20% of that stock and you put in alternatives and 10% of the bond, it goes back into to the left and up, which means less volatility or less risk and better return. And even when you take 80% of stock and 20% bond and you go back to 50, 20, and 30, it still increases the return and reduces the risk significantly. So what is the theme here? The theme is diversify, diversify, diversify. If you have in your portfolio nothing but, Fidelity, Magellan or Fidelity Contra Fund, make sure that you are also including some alternative investments within the portfolio. It will help reduce risk and increase return. And finally, this is probably the biggest theme of 2023 and something to think about. All right, so this is as of September 22nd, so this slide's a couple days old. But on September 22nd, at the close of the market, the S&P 500 was up 12.97%, roughly 13% year to date. But the equal weighted S&P 500, well, what is equal weighted, Ryan? The S&P 500 is a market weighted, meaning the largest company, Apple or Microsoft, whichever one it is after today, accounts for the biggest slice of the pie of the S&P 500, and American Airlines or whatever the 500th company is like a little tiny piece of the pie. So they don't affect the performance of the S&P 500 as much. If you take all 500 companies and you give them an equal weight, meaning Apple is the same size as American Airlines, Home Depot is the same size as Procter & Gamble, and Microsoft and Google are the same size. So everybody's the same size. The equal weighted S&P 500 was up 1.11%. And then after today, my guess is it's flat or down for the year. And that, again, that spread between the S&P 500 and equal weighted is as big as we have ever seen it in the markets, which means very, very few stocks have been driving all of the returns. Very similar to the end of 2021, which is why I think there's a lot of danger lurking in the waters over the next 3-4 months. If you look here, look at the difference between the Dow up 2.5% versus the NASDAQ up 27.2. Again, that tells you right there that those tech stocks have completely led this rally. And they also happen to be the biggest stocks that are down today, right? Because everybody crowded into the same stocks, into the same trade, and now everybody's coming out of them. So it's going to really affect the indexes at the S&P market weighted index at the highest level. So themes for 2023, tech is certainly propping up the broader markets. Strip away the tech companies and equal weight them, and the markets haven't really done almost anything this year. If you have had exposure to alternatives and commodities, you've done very well this year, right? It's been a ballast to the portfolio. We think the markets are range bound through the end of the year. Very choppy time. Historically, August through October is the worst time in the market. And then November, December, January, historically the best 3 months of the market. So even though I'm saying, yes, we could have some significant downside in the near term, remember that the markets can rally very quickly. So advice moving forward from here, if you have cash, or if you're, overweighted in, let's say, money markets or CDs, maybe get some of that ready because the markets are coming in right now. And I think there's going to be some great buying opportunities in the next 2 to 3 months. Again, we think that we are approaching a recession. That recession is probably going to start fourth quarter this year or first quarter next year. Remember that the market tends to bottom 3 to 6 months before the recession is over. So if it's what we think is going to be a light to a moderate recession, so let's call it 2 quarters, then you would expect the market to bottom probably sometime in the next 3 to 4 months. Again, going to be some great buying opportunities out there. And this will all encourage the Fed to pivot and begin lowering interest rates, which once again will be very beneficial to stocks. So with that being said, done for our first presentation here of the year, about 30 minutes in. So I want to open it for questions. And again, I wanted to make sure I address the elephant in the room. September has been an awful month so far for the markets, and we don't expect any quick bounce back. We definitely expect some more downside in October. So I'll go ahead and open it up for questions.